Here are 3 stats I found shocking. 3 in 4 people don't know the annual ISA allowance. Almost 1 in 2 people don't know about the benefits of an ISA. And over 1 in 10 don't even know what an ISA is. If you fall into any of these brackets, you need to watch this video. We're not taught this stuff at school, so it's not your fault, but it is really important. Hi, I'm Matt. I have over 15 years in finance. I did stints at 2 top hedge funds, and I'm a CFA charter holder. An ISA is an individual savings account. There are different types, but the main 2 you might have heard of are cash ISAs and stocks and share ISAs. The cash ISA is well known. It pays a fixed amount of interest each month, although the frequency of payment can differ between providers. The interest rate can and does change over time, but generally speaking, you know what you're going to get each month. The stocks and shares ISA allows you to invest in stocks and funds. This is the true investment savings account, allowing you to gain exposure to domestic and international shares. It has the potential for more growth than a cash ISA, but it contains more risk and you can lose some of your money. Over the long term though, you're more likely to make money than lose money. The annual allowance is £20,000. That means that each new tax year, running from April to March, you're allowed to deposit a maximum of £20,000 between your ISA accounts. Now this can be split into any proportion that you want. So for example, you could do an equal split of 10,000 into the cash ISA and 10,000 into the stocks and shares ISA. Or you could do the whole 20,000 in one or the other. But you can't put more than 20k in both. Note that from April 2027, the limit on the cash ISA will be reduced to £12,000, meaning if you wanted to max out your allowance, the other 8,000 would have to go into the stocks and shares ISA. ISA benefits are best explained by using a comparable standard investment account. If you invest the full amount into the stock market each year, so we're saying 20,000 here, and let's say on average that you earn about 8% a year, which isn't out of the ordinary, and 3% of that is a dividend yield. Over a 20-year period, without paying any taxes or fees whatsoever, you would make almost £1 million. Now here are some examples of typical fees that you could pay. And these are really important because they look small, for instance here the 2%, but look at what that translates to over 20 years. £135,000 paid. If you include the opportunity cost of those fees reducing growth, it's over 220 grand. Now, I cover fees in more detail in my other video, link above, it's definitely worth a watch. Assuming you invest in low-cost index funds or stocks outside of an ISA, if you don't shield your investments, as in this situation, you're liable for about £75,000 in capital gains tax. Now, ongoing investment fees, the fees that you're charged each year, are not tax deductible. So you must pay tax on all the gains with fees as a separate cost. How angry would you be handing over £75,000 to the Chancellor, knowing that you could have easily avoided it? If you don't use an ISA, the government will tax you every time you receive a distribution from a fund or a dividend from a stock. This is especially significant for dividend investors. So when you reinvest your dividends, you're potentially only reinvesting 60% of the dividend, assuming you're the highest rate taxpayer. This means you'll also miss out on any future growth that whole dividend may have produced, potentially leading to a lower ending balance at the end of 20 years. So what's all the fuss about? No tax is paid on profits or dividends or interest in an ISA. Just look at the ending balances here. You're giving away £285,000 in this scenario. This means that you can reinvest the whole gross dividend amount, and more importantly, when you come to sell your investments at the very end, there'll be no capital gains tax to pay. However, note that withholding tax may be applied to foreign dividends, which isn't always reclaimable. For example, in the US, 30% withholding tax is applied to dividends paid to foreign investors. If you're from the UK, you can reduce this to 15% by filling in a weight bend form. It's definitely not said like that, by the way. Ask your broker about it if you haven't filled one in already. You can have as many bed and breakfasts as you want. What do I mean by this? Well, because there's no tax to pay, you don't have to bother selling and rebuying a stock to make use of your capital gains allowance. It relieves you of all the cost basis headaches. Outside of an ISA, if you sell out of a stock to make use of your capital gains allowance, currently a measly £3 grand, you have to wait 30 days before you can repurchase it. Otherwise, HMRC will keep the initial cost basis, meaning you'll pay more tax later down the line. Sounds complicated? Doesn't need to be. Just know you should open an ISA. And for those of you sitting on cash in your bank account, a cash ISA allows you to earn interest without paying any tax on it. The rates offered are likely to be higher than your current account, so you're far better opening a cash ISA in this situation. Right, if you don't have an ISA, how can we reduce tax burden? Number 1, get an ISA and maximise your allowance. If you haven't got the hint already, I'll be blunt. Open an ISA. You can invest up to $20,000 a year, as we've said, in any mix of the two between a cash and a stocks and shares ISA. Any gains whatsoever? Zero tax. Any interest and dividends paid? Zero tax. This is the single most powerful tax shelter available to UK retail investors outside of a pension. Note, as we said, from April 2027, the cash ISA maximum allowance is going to be £12,000. Number 2, transfer existing investments into an ISA. You can move existing investments into an ISA account, and this is called a bed and ISA transaction. Now, you may have to pay capital gains on the transfer because you're potentially crystallising any profits by selling your investments and then rebuying them in the ISA. But from that point onwards, they'll be completely tax-free. So if you are investing outside of an ISA, consider a transfer. And note that transfers do not use up your allowance. So go bananas. Number 3, use your SIP, self-invested personal pension in the UK, or 401k in the US. In the UK, pension contributions get tax relief. Basic rate taxpayers get 20%, high rate get 40%, and additional rate get 45%. Plus investments inside grow tax-free. And note, the max annual allowance is £60,000 before tax relief stops. Number 4, your partner's allowance. Married couples can use both partners' ISA allowances. So if your partner doesn't use their allowance, you can gift them money so that they can max it out. Beneficial to you both. But it must be a legitimate gift. And that's almost £40,000 per year you can shelter from tax as a couple. 5, strategic use of capital gains tax allowances. If you have investments outside of an ISA, then you can consider transferring them into an ISA in stages, selling down your assets gradually to make use of the £3,000 capital gains tax allowance. Now, I know it's not a lot, but you can shelter your investments from tax by doing this. You could also consider transferring assets to your spouse, who may be in a lower tax bracket. Take advantage of their capital gains allowance and lower rate of capital gains at potentially 18% instead of 24%. The US estate tax trap. If you hold US assets outside of an ISA totaling more than $60,000, then you're liable for US estate tax, even though you're not a citizen. That's a 40% tax headache you don't need. US assets in an ISA saves you the headache. If transferring to an ISA is not an option, then consider selling small amounts each year to use your capital gains tax allowance. Depending on the size of your portfolio, might not be worth the hassle, but it's still £3,000. How does it work? If you sell and repurchase your holdings, you take advantage of a capital gains tax allowance and increase the cost basis of your holdings. This means you'll pay lower tax in the future when you fully dispose of the position. However, you will have to wait 30 days before you repurchase the holdings again after initially selling down. If you don't want to miss out on the stock movements in that 30-day window, you can temporarily gain exposure through CFDs or spreadbets on the same asset. Wait 30 days, sell the CFD or the spreadbet, and buy back into the original equity investment. CFDs and spreadbets are not the same. They're different instruments in the eyes of the taxman. If you want more information on these two products, then let me know in the comments below. Why would you do this? It increases your cost base of your position for lower capital gains tax later on down the line when you exit the position. Also, if you're buying UK shares, their CFD equivalents do not charge stamp duty, but they do charge financing fees as you're effectively borrowing to take out the position. Again, if you want more information, let me know. Allowances are shrinking and tax rates are rising, and if you're not using an ISA or a pension, you're losing money every single year. If you take nothing else from this video, open an ISA and max out your allowance. Even if you can't max out the full 20,000, put whatever you can afford into a stocks and shares ISA. Think long term, chuck money in like it's another bill, and forget about it for a few years. You'll wake up one day with the same feeling as when you find a tenner in your pocket. If you want to understand exactly what fees you're paying, then you must watch the next video. I'll see you in a bit.